So this is the second video in our time value of money series where we're going to look at the interpretation of interest rates. So in the last video we looked at the fact that interest rates can be called different things depending on different circumstances. So they could be called the discount rate if we're looking at pricing some sort of an investment or future cash flow. They could be called or referred to as the rate of return. Rate of return. They could be called the opportunity cost. So if I have a sum of money, I can do many things with that. I can invest the money, I can buy consumer goods with that money, and the return on an investment is the opportunity cost, or the costs that I forego for choosing some other use of my money. So they're the different types of sort of uses of interest rates and the different names that we can give interest rates depending on the circumstance. But what factors or parameters actually go into determining the interest rate? So we start off with our risk-free rate, and normally this is based off the price of government bonds. Specifically in the United States, Treasury bills. So the government bonds provide a risk-free investment. It's highly unlikely the government's going to default, and government bonds or Treasury bills in particular, or T-bills for short, are on a short-term basis. So there's sort of limited maturity risk involved in them. So we start out with our risk-free rate in finance, which is based off our T-bills, which are a type of government bond, essentially. Then we have our inflation premium. Our inflation premium is going to contribute to the rate of interest that we command as the inflation effect of our money occurs. A dollar today is not going to be worth $1 in the future. And so when we hand over our money for investment purposes, we need to be paid a premium so that our money keeps up with inflation and we're not losing value there. So the inflation premium is sort of required. And then on top of that, depending on what we choose to invest in, we can also command various other premiums as well, which make up the rate of interest that we're going to earn. So these are our default risk premium, our liquidity premium, and our maturity premium. So if we were just investing in a T-bill, all we're going to get is our risk-free rate of return, which is going to keep up with inflation and give us a little bit more as the risk-free rate, but very low returns comparatively to shares and other investments. So the way that the returns on other investments such as shares are priced is a combination or a sum of all these three other premiums plus the risk-free rate. Because if our share was giving us a return that was less than the risk-free rate, we'd just invest in the risk-free asset and we wouldn't bother investing in the share and taking on more risk. So the default risk premium is the level of default risk. So default risk is the level of risk that the entity we've given our money to, so in the case of a share, it'd be the company, or if we bought a bond, it would be whoever we've loaned that money to, potentially a government or a company. It's the risk of them defaulting on their payments. And so obviously if you've got a very high risk company that's unstable, it's got cash flow problems, they're going to have quite a high amount of default risk built in. We also have the liquidity premium. So on a timeline, if we look at corporate bonds or even shares to a certain degree, shares, especially listed shares, are very liquid, and so we can easily sell them on the market. So listed shares are very liquid. So if we're unhappy about how our company that we've invested in is run, we can just go to the market and sell our shares on the share market and convert our investment to cash, to liquid cash. There's high liquidity there. Whereas if we invest in a stock that's not listed, we can't just go to the marketplace and sell our shares on the market for the market price. We have to go out and find a buyer, which means our investment is very illiquid. So if the investment is illiquid, then we're going to want to command a premium for that investment. So that gives rise to the liquidity premium. Then finally we have the maturity premium. So if we look at a timeline and we look at investing in a fixed income security or fixed income investment, specifically let's say a corporate bond of some description. So we have our time 0 here, and we have two choices of corporate bond to invest in. One that matures at time 3, so 3 years from now, and another one that matures in 15 years from now. Obviously, the longer the maturity, the higher, the greater the premium that we're going to command. Because if we're not going to get our principal back from our corporate bond for 15 years, we're going to want to command a higher rate of interest than if we get our maturity back in 3 years' time. It locks our money away for a longer period of time, and therefore investors command a premium for that extra time that their money is locked up for. And that's all going to contribute to the rate of return or rate of interest that they receive. Also, over longer time horizons, they do sort of affect each other. A longer time horizon investment might be more illiquid, and also the fact that you're exposed to the longer time horizons may increase the default risk. Obviously, if a firm or a company that you've lent money to looks good and the fundamentals look good for the moment, they might have an extremely low probability of default in the next couple of years. But when you're looking at long time horizons of 15, 20 years, well, who knows what the market and economic landscape is going to look like then. So you can't be so sure that the default risk will be low, and so therefore the longer maturities are going to expose you potentially to greater default risk. So that sort of summarizes learning outcome B of the time value of money chapter. If you have any questions, please just post them below, and subscribe for more financial content.